Chapter 10: Governance in Business Organizations and Sustainable Business Practices. In this chapter, we will explain three key topics: agency problem, corporate governance, and corporate social responsibility. But the core of this chapter is about corporate governance, and we will first introduce the agency problem, which is highly related with the corporate governance, and then we will conclude this chapter on corporate social responsibility. So let's start to discuss about the agency problem. Agency problem. First, what's the definition of it? The rationale behind agency problem is we have to understand why do we have the corporate governance, because we have the agency problem. And particular in large companies. In larger companies, there may be many external shareholders who play no role in the day-to-day running of the company. That means many shareholders, they are small player or they are minority interest in the company. They play a very small role or even no role in the day-to-day operation. In other words, there's a separation of ownership and management. But remember, what we discussed here about agency problem is for relatively larger companies. And the ownership and management here, the ownership and management are separated. For entrepreneurial structure companies or organization, the ownership and management is the same person. There's no separation. So in this case, there's no agency problem. But in larger company, because of the separation of ownership and management, then there's an agency problem, and we need to dig into it and to find a solution. And for larger company, because of separation of ownership and management, it refers to the situations in the company where the people who own the company, that is the shareholders, are not the same as those who run the company, the board of directors. We will explain what is board of directors later, but here the concept is clear. In larger companies, because the owner is not the same as the manager running the business, there's a separation between them. So there is an agency problem arise in this scenario, in this case. And the separation have some benefits. You have the small owners and you have the manager. So there's a separation. And the first benefit from this is the managers, because they are specialists. They can often run the business more efficient than those who own the company. It's very clear for a listed company. For example, if you buy the shares in the stock exchange of a listed company, you don't know how to run that particular business as an investor, because you only look for dividends or capital gain on holding the shares, and you rely on the manager running the business to make profit and to deliver the profits to you. So here you can find the separation, can benefit both parts, can benefit for the investor. And for manager point of view, managers, they cannot personally contribute all the capital needed to run the business, especially there's a capital intensive business like oil industry or motor industry. They required a lot of capital invested in the machineries, in the equipments to produce the profits. And the managers are seldom have adequate capital to do it. So they have to ask from investors to invest the capital into their business. So the investor bring the external capital into the business, but for many investors, they are not interested or they don't know how to run the operations on a daily basis. So they have to rely on the specialist manager to do it. So the separation of ownership and management have these benefits for both parties. And now we go into the details on agency problem. There's a risk, as mentioned before, the separation of ownership and management. There is a risk that the directors in the board of directors may run the business in their own interest, rather than those of the shareholders and other stakeholders. This is referred to as agency problem. One example is the directors, they are looking at their personal interest. Say they would like to have a significant growth of the business or the companies. They are looking a relatively short-term period of investments to have an initial or substantial gain in the first year or second year, because it can help them to have a good resume or CVs, because they can deliver. They can make the companies to gain much more. But sometimes they are sacrificing the long-term benefits of the company because they are just looking at their own interest. And here is an illustration to explain the separation of ownership and management for a listed company and how to solve it. Imagine here there's a company with the board of directors. They regularly meet with each other, and these directors, they may hold a board meeting and vote themselves for huge salaries, bonus shares, even if with the profit target can be achieved. And once they are dismissed, they can have a huge compensation payment. If you will ask whether these are the most benefit to the company, the answer is no. It's just the best interest of the directors, but not for the shareholders who own the company. And the problem of directors not operating in the company's best interest can be solved by aligning the interest of the directors and the interest of the company or the shareholders. For example, shareholders are looking at the share prices and the dividends paid by the company. So the directors could be paid a small basic salary and bonuses. So they still have entitled the salary and bonuses on cash, but at the same time, directors could be paid partly from the shares to make them shareholders, so that they have the direct interest in the share prices or in the share price here and the levels of dividends. Adopting such procedures would reduce the agency problem, because here in the case, the directors, they have tiny or small portion of their compensation in cash or salaries paid on each month. At the same time, they are entitled to for the shares, so they can also benefit from the share price increase and the dividends paid by the company. In this case, part of or the agency problem can be minimized, because the directors will not only act as an agent of the company, but also act as an agent for themselves. So after discussing the agency problem, why we have the agency problem and where can we find the agency problem, is normally on the big companies, and also the director's interest as well, and whether the director's interest and shareholder interest are separated because of the separation of ownership and management, and how can we find a solution to align them with each other. And next, we will talk about the corporate governance. We have discussed the agency problem, and we'll follow the discussion on corporate governance. For corporate governance, it is the set of processes and policies. So sometimes people think corporate governance is a boring stuff, because it's about the processes and policies by which a company is directed administrated, and controlled. So what are the proper policies and processes for? Is for direction, administration, and being controlled of the company. And it includes the appropriate role of the board of directors and of the auditors of the company. So it's not just the document itself. It sets the roles of board of directors and as well as the auditors of the company. The main recommendations of best practice in effective corporate governance tend to include different areas. First, the membership of the board of directors. We have executive board of directors and we have non-executive board of directors. So the membership of directors, they are not all the same. Some are executive directors and some are non-executive directors, and we should have a ratio on it. We will explain the composition of board of directors in later part of this class. And next, how directors' remuneration decided and disclosed is another recommendation of best practice in an effective corporate governance. It's about the directors' remuneration. How do we determine the remuneration for those directors, and shall we or how deep of the disclosure for those directors' remuneration? And third recommendation here is the role of both internal and external audit. Okay, so here is also another recommendations under the best practice of corporate governance. And the final recommendation here is how the public, as a legitimate stakeholder in a large company, has a right to know how the company is being governed. All these recommendations come from the reports. There are two reports. One is Cadbury report, published in 1992. It's about the financial aspects of corporate governance. And an enhancement of this Cadbury report was published in 2004, which is by the OECD on principles of corporate governance. So all these recommendations are officially published with the government body or the global associations of corporate governance. In the company law, it refers only to directors in general. But there are two types of directors have emerged. As we mentioned, one of the recommendations of best practice is the composition of board members should have both executive and non-executive directors. For executive directors, on the left-hand side here, those who are involved in the day-to-day running of the company. So it's quite simple, it's straightforward. Executive directors, they are managing the company, they are involved in the operations, they engage with it. And for non-executive directors, they are not employees of the company, first of all. And they have no managerial responsibilities. That means they are not responsible for running day-to-day operations. They are not participate for it. However, non-executive directors do attend board meetings and therefore have a say in the strategic decision-making of the company. In other words, the NED, non-executive directors, they are part of the management team or they are part of the composition of the board of directors. They have the responsibility to set the directions or advise for the strategic directions of the organization. And non-executive directors have several key roles in the organization, including first, strategy. Non-executive directors should constructively challenge and contribute to the development of strategy. So they cannot hide themselves. They need to contribute like a sounding board to to the whole board of directors on the organization development strategy. And next, performance. Non-executive directors should scrutinize the performance of management. So it means that they have the role to monitor the management team in meeting the agreed goals and objectives and monitoring other senior management team members. So for the performance, no matter it's for other board members, for those executive directors, and for the senior management of the company, they have the responsibility to monitor the performance of them. And next, risk. Non-executive directors should satisfy themselves that financial information is accurate, is very important, and that financial controls and systems of risk management are robust and defensible. In other words, for this area or for this role, for the risk role, non-executive directors can work with the auditor to look for any risk and to minimize them as well. The last role of non-executive directors is about people. Non-executive directors are responsible for determining appropriate levels of remuneration is appropriate for executives and have a prime role in appointing and, where necessary, removing senior management and in succession planning. So non-executive directors is very crucial in the people structure as well, because they determine the remuneration should be fair, should be enough for those executives working for the company, and they also have a responsibility to appoint or remove any senior management team members. You will ask a question, there are so many works for non-executive directors, but what is the key? The key is, no matter you are determining the salaries of your executive or setting strategy for the company as well, and monitor the performance of the senior members and to do the risk management, non-executive directors should be independent as far as possible. It's the core. If it's not independent, no matter it's for strategy, performance, risk, and people, it's not useful or even it's no value. So they should be independent in order to ensure that their oversight role can be carried out as effectively and responsibly as possible. So here it's very important for you to understand well the difference between executive and non-executive director is independency. For executive director, they are looking at day-to-day operations. So they focus on the operations itself. And for non-executive directors, even though they are not responsible for day-to-day operations, they are still valuable in contributing for the strategy, for performance monitoring, and for people management as well. So they need to be independent for them to provide their insight to the company and to make sure the corporate governance is ensured. As said, non-executive directors should be independent, and here are the examples impairing non-executive directors' independency. First, if the non-executive director is appointed and this non-executive director has been an employee of the company in the last 5 years, it is considered his independency is affected or even impaired. Second, the non-executive director has a material interest or business interest in the company for the last 3 years. That means there is a money relationship between himself, the non-executive directors, and the company for the past 3 years. It will also impair his independency and also for the judgment as well. And the non-executive directors participate in the company's share options and pension schemes. It is very obvious because if the NEDs, if the non-executive directors have the shares, is probably looking for short-term solution instead of long-term vision on the company. For the NEDs, it has close ties with the company directors or senior employees. It is also negative to his independence as well. And another example is the non-executive director serves as an NED for more than 9 years with the same company. It doesn't mean that the NED cannot work for an organization or for a company as an NED for more than 9 years. But if the NED does so, he should be elected on yearly basis after 9 years to ensure all stakeholders or all shareholders are voted for them or for him. Here is an example of a board of directors composition structure. At least half of the board members should be independent or independent NED. So you can see here, we have the NED, the non-executive directors here, which is 4 of them, and another 4 of them are executive directors. So here are all executive directors, and on the right-hand side, here is all directors are independent non-executive directors. For a smaller company, they don't need to have 8 members in the board of directors. If they can only have 4 is enough. So in this case, at least two of them are independent non-executive directors. And one of the independent non-executive directors should be appointed to be the senior independent director. Here, they are available to be contacted by shareholders who wish to raise matters outside the normal executive channels of communication. So for this senior independent director, his role is communicate with the shareholders at the same as the contact points, because the shareholders can raise matters to this senior independent director and not directly to the executive directors. It is also worth noting that good corporate governance recommends that the role of chair, that is the chairman, should be distinct from the chief executive officer. That means the chairman should not be the CEO as well. Given if any one person holds both roles, that is the chairman and CEO of the company, it will give them too much power and allow them to individually dominate the running of the company. It's true. It's true that a person appointed as the chairman and CEO of a company, the company culture will be like a power culture or entrepreneurial culture, because the one person determines all things of the organization, and it's not good for a stable and large corporations. Maybe it's good for startup, because for startup it needs quick decision-making process, need a strong man to steer the company to move forward. But for big organizations with stable environments, it's not appropriate to do that. And for executive directors and non-executive directors would typically be required to stand for re-election by shareholders every 3 years. So here, for all these directors, no matter it's executive director or non-executive directors, they should be reappointed every 3 years by shareholders. And as said, non-executive directors is not suggested to be with the company for over 9 years. And if it is the case, then these NEDs must stand for re-election on an annual basis. So here is some additional learning for you to learn from the role of board of directors. Nearly all large companies are managed by a board of directors, appointed or elected by the shareholders to run the company on their behalf. And there are different roles there are different roles of the board of directors as summarized by the King report. It is a report stating the role of board of directors. First, to define the purpose of the company. So here, for the board of directors, the first role is to define the purpose of the company. And next, the board of directors need to define the values by which the company will perform in its daily duties. And next, the board of directors will identify the stakeholders relevant to the company, and the board of directors will develop a strategy combining these factors. The last role of board of directors is they have to ensure implementation of this strategy being drawn alongside with them. The purpose and values of a company are often set down in its constitutional documents, reflecting the objectives of its founders. However, it is sometimes appropriate for the board to consider whether it is in the best interest of those served by the company to modify this or even change it completely. So here we have 5 roles of board of directors, and for the directors, they must look at the long-term interest or long-term perspective of the company instead of short-term. In-class question time. Here we have one in-class question for this class. The question is, the separation of ownership and management refers to the fact that the owners of a company are always different people to the directors of the company. In this statement, is it true or false? Remember, what we discussed here about the separation of ownership and management is arising from the agency problem. And you have to ask yourself, in this class, do we discuss about this problem, agency problem, can be found in every organization or in some particular organization? If it's only in some particular organization, then the statement is false. If it's happened in every organization, then it's true. So you have to remember, or you have to understand what we discussed in this class. And yet, if yes, you understand it well, then you can pick the right answer in this statement, in this question.